And if you don't mind, I'm gonna stay off this time. I
That,
just,
that
just
that's
finished
cool.
moving furniture now.
That's all right. That's all right. That's cool. That's cool. See Jamie out there. Dora. Hey, Dora. Always good to see you. Awesome. All right. Well, today is Saturday, June 17th. This is Saturdays with Eddie. And what we're doing is talking about options. This is a session that is open to pretty much anyone. So you can invite your neighbor, your friend, your coworker, whoever, anybody, and just show up with your questions. We'll talk about it and help you out. So we've got a couple of topics. Oh, before we go there, this is educational, right? So it's not financial advice. Anything you hear here is educational. It means that if you try it out, be sure you completely understand it, do your research, make sure that you can take the risk. Yeah, because you can make a lot of money or lose a lot of money, one of the two, or just go flat. So cool. A couple of topics. Market is on the uptake, and we want to understand what rates are doing or the effect of that. This is again opinion, by the way. When the markets, well, topic number one, when the market's on the or stocks are on the rise, like we saw for a lot of tickers, I think this is we're experiencing kind of a small recovery, if you will, especially with the news that came out from the Fed. That's probably what's happening. But we've been on the downtime, on the downtrend forever and ever. We've just been, it's just been debilitating. Just seeing that SPX come from 4,800 all the way to 30 something hundred. I think we went as low as what, 3491 back in October. Yeah. And some analysts had said 3600. Well, we blew right past 3600 all the way to about 34, 35, let's call it 3500. So now we're recovering. That's what's going on. And because we're recovering, what it means that, Marlon is right there. We're looking for support, and support that seems to be so far away. And when we draw it, we're not sure where it's going to end up, right? So how do we trade that? I think that one of the ways to do that would be we've been doing it on the upside when the markets were going, when the prices were going down, we've been selling on the upside. But now that it's going on the upside, we simply reverse direction, right? We reverse direction by selling premium on the lower side. So here's what I'm talking about. I'm talking about put credit spreads. So put credit spread is a bullish strategy, even though it has the word put in it. That put is actually negated by the word credit, means that you're receiving some money to open the trade. You're receiving money to enter the trade, and your best case scenario is that option contract or that spread expires worthless. I think we've talked about credit spreads over and over and over again. So, but just as a quick primer, when you're dealing with or working with credit spreads, you're selling where price is not going to go, and your thesis is that price is not going to go to that level. And if it does not, by the time that contract expires, then you get to keep 100%. If you are familiar with the way that I trade, the way that I teach about credit spreads is you're never 100% guaranteed that it is going to expire in the money. Because I am risk averse, I will always close the trade very, very shortly after I open it. After I hit the target profit, then you close it. That's how you manage that risk. The reason you manage the risk that way is because spreads are very expensive in terms of max loss, or in fact any loss. They can get pretty wieldy. They're not kind at all.
Hey Eddie.
So, yeah.
What expiration are you talking about?
0.
Okay, thanks.
So anytime that you're selling, it's always going to be 0 DTE or as close as possible to 0. Yeah. If you're selling, if you're buying, excuse me, if you're buying, then you're going to go 45 to 90 days, depending on the strategy that you're using. But when you're selling, you always want to go the shortest expiration date. The shortest expiration date. So it's almost always zero. And we do credit spreads on indexes exclusively. Not that you can't do a credit spread on anything else, but the reason we favor indexes is because of eliminating the risk of assignment. They're cash settled. Cash settled means that there are no shares to be assigned. For example, if you sell on the S&P 500, you really can't own a piece of the S&P 500, right? So options assignment and exercise is in the form of cash basis, means that your account has to be good for the money. That's why you need that that extra privilege to be able to trade spreads.
Are ETFs cash settled?
Negative.
Okay.
They are not. They are not. ETFs, you can own an ETF. You can buy an ETF, a piece of an ETF or a whole ETF and hold it a year, 2 years, 10 years. You can do that. An example of an ETF is SPY. SPY is an ETF, exchange traded fund. Actually, no. SPY is an index fund. An ETF example would be actually, yes. SPY is an ETF. It's mostly better known as an index fund because it very, very closely tracks the S&P 500. Did you say VTI? Is that what you said? Somebody was speaking. Yeah. Think of a, well, I'll tell you what we can do. We can go find an ETF to all right, QQQ is an ETF. That's a great example. QQQ is an ETF. You can own QQQ, right? So whose question was that? Was that Junior? No.
That's Jamie.
Okay, Jamie. Yeah. So with ETFs, you can be assigned, and there's the risk of if the price comes close to your spread, and the broker determines that your account is not good enough for to hold any sort of assignment or exercise, then they will close that position for you. They don't ask you. You already told them it's okay to do that when you open the account. If you read the fine print on page 372, walk with me here, it's a joke. But on page 370 something, you say that it was okay for the broker to do what was best for them, not for you. Yeah, let's let that sink in for a little bit there. You said it was okay for them to do what was best in their interests. And if in their interest, it means that they're going to close the position because they might suffer some losses, they will do that very, very quickly. In fact, they automate that. So when you're selling indexes like SPX, that risk is reduced. The risk of automatic pin closure or pin assignment or pin risk, it's called pin risk, does not exist. So on the uptick, what are we doing? We're saying that we don't think prices are going to come below a certain point, and so we sell premium at that level. If I were to go to SPX and go to the options chain, this is on Tuesday, the 20th, change that over to a vertical, then I think that the 4400 PDS right about now is selling at about what, $1.60. So this is how you would do these things. You would sell, but notice that when we're selling, you don't sell too far in advance. You actually sell on the day off. So come Tuesday, this premium is more than likely not going to be 160. It's going to be much less because it's going to be decaying, right? It's decaying right now as we speak. The theta does not stop, right? Yeah, happens on the weekends, on holidays, all that good stuff. So by Tuesday, this is not going to be 160. This more than likely going to be about 70 cents or something like that. But To answer your question, I know I took a long time answering that question. To answer your question about what do we do in a market uptrend is we sell on the downside. And if you can identify stocks that historically have had higher highs than what we have today, then you can go for those and make sure you have a really, really good stop loss. Stop losses, by the way, they're not optional. No matter what kind of strategy you're working with, they are not optional. Does that help? Yeah, hopefully that helps.
Hey, Eddie, I got a question.
Sure.
How do you put a stop on a vertical spread?
On a vertical spread, what you can do is you can set it up as a bracket order. Let's do an example, right? So I've got this one queued up over here, which is the 44.5, 4,500. It's a put debit spread. Yeah, it's too close to the money. Let's work with something different. I'm going to go with this 90.95, which is a 5-point wide spread, picking up $1.05. You with me so far?
Yes.
Yep. Okay. And to turn this into a bracket order, it means that you want to send 3 orders at the same time: a take profit and a stop loss. So I want to change these from advanced single order, and I want to change that one into fast triggers OCO. That's step number 1. I'm in Thinkorswim, by the way. So if you're using another platform, the steps will be kind of similar, but your mileage may vary on that. So I would right click anywhere on this sell order, and I would create the opposite order. Remember, I want to do the opposite of what I did to open it. And since this is my opening order, then I would create an opposite order on that. All right, that's step number 1. And then again, I want another similar order like that one. So now I want a duplicate order. All right, so now I've got 1 sell and 2 buys. Right, let's change a few things now. So Jamie, if I sell this for $5 and I want to make some profit, should the buyback, it should be lower, right? So how much lower do we want this to be?
50 cents.
50 cents. All right. So you're looking for 50 cents in which case then I want to sell this for what? 55 cents. Is that right?
Let's sell it.
I want to buy these for 55 cents. I'm sorry. I said sell. I want to buy.
Okay. Yeah.
Yeah. So 105 minus 0.5. Then I want to buy it back for 55 cents. And that would be a limit as well. And then the next one is my stop loss. So guess what? I'm just going to change this word from limit to stop. And because this is a credit spread, it means that if the value of this spread increases, that is not in my best interest. Right? So we sold it at 105 and I want a 1x stop loss, then that should be 2 times the amount of premium that I receive.
210.
So 210 would be my stop loss. That is correct. Yeah. So if that actually happened, it means that I would actually lose $105. That's what that means. Okay. How much I received, that's a 1x would be multiplying how much you received times 2. It means that I would give back the 105 and lose another 105. That's a 1x. A 2x is would be adding 105 to that, which does not make sense at all. In fact, the maximum stop on a 5-point wide spread should be 250. Right. The reason it should be 250 is because that is half the width of the spread. Okay. What does that mean? When it's half the width of the spread, the chances of recovery are next to 0, right? We should know that.
Be hard to sell it. Yeah.
It would be hard to buy it back at better than that. Yeah. So when the value of the spread has increased to half its width, that is almost a point of no return. At that point, it's almost guaranteed loss. Unless you sold it for like $3 or $4, not uncommon, by the way. There's a strategy for that. unless you sold it for way more than that, then it's not going to work out. Okay. And then you would push confirm and send, and that would give you your bracket order.
Okay.
Yep.
Thank you, Eddie.
Sure, no worries. Sometimes you actually enter this kind of spread without a stop loss. So there's also another way to modify the order after you have entered it and apply a stop loss on that. Yeah. I don't have any open orders right now, so it's kind of hard to simulate that. And we'd have to go to on demand for me to show that to you, but there is a way. Good question.
So Eddie, to clarify something, I don't know why this always trips me up, but when you receive credit, say like for $1.60,
Mhm.
and I know you said you never want to exceed half the width of the spread
For the stop loss. Yeah.
right, for the stop loss.
Yeah.
So if you were to go 1x on 160, that would be what, 320?
Yes, but your stop
Yeah.
loss would, but you wouldn't use 320 as a stop loss. You'd still use 250, not 320.
All right, that's why I just want clarification.
Okay. Yeah. So the rule, or my rule, is twice the amount of credit received, but no more than half the width of the spread. Yeah.
Absolutely.
Cool. Cool. All right. It's a good question on that, Jamie. Let's see, rates. So what are my thoughts on rates? I think they were in line with what JPO did. Obviously, I was depending on some of the analysts that I listened to a lot, and I like varying opinions. And I heard so many opinions from different people until a point where you have to like, yeah, this one's a lot of hot air. This one's more real. But generally, I was feeling the same way, that we were either going to pause, or if there was going to be an increase, it was going to be very, very, very tiny, very, very tiny increase, not the 25 basis points, maybe a 20 basis points, or even a 10 basis points. I was actually expecting a 20 basis points, but nothing actually worked just as well. I think that did wonders for the market. That's why the market went up, because essentially when the rates are going up, it is not very, very friendly for the market. So when they paused, that was good news, and that's why the market rallied until next month. So next month, I expect that we're going to come back down. Why is that? Because I think that the Fed is going to bring back the rates. Remember, he did say that they are targeting 5.6 as the final rate for this year. So we are at 5.25 right now, which means that we still have another 35 basis points to increase it to. It is unlikely, unless we see some really strong inflation numbers coming back and some CPI and PPI telling us that the market is again too hot, too strong, then it is very unlikely that he's going to increase it by 35 basis points. In fact, the highest that he did increase was by 50 basis points last year, and that was, I think, just once. Every other time was by 25. So if he did increase, I think it would be kind of pared down to, he might even go 3 times or 2 times, maybe July and August. Typically strong months for the American economy, but I think maybe 25 basis points is not out of the question next month. Then again, he could be flat. He could continue the pause if things continue to work well. So that's my idea on rates. I think that was Regina asking what the heck is all this thing about rates. The objective is to control inflation, which is right now about 4 point something or thereabouts, and the target is 2%. Now, mind you, even 4% inflation is extremely good. when you compare that there are some countries in the world that have got double-digit inflation rates. In fact, some entire countries have economies have been wiped out just because of hyperinflation. A good example is, I think, Venezuela, Zimbabwe. Zimbabwe, their currency went valueless, right? You couldn't go to the ATM to withdraw money because the minimum withdrawal was like $1 million. They haven't a million of their currency, that is. Their currency was so devalued that when somebody says they have $1 million in their pocket, they really do. And all you can do is buy a loaf of bread with it. It's that bad. So hyperinflation, by the way, if you're not very familiar with it, hyperinflation is probably the top enemy of a country's economy. If you have hyperinflation in a country, then that is not good for you, not good for that country. And that's why the Fed is very, very insistent on controlling inflation before it gets to hyperinflation. If we get to too high, if that number gets too high, it's I think it's synonymous with maintaining the engine, the temperature of your motor, right? Your car's engine gets too hot, things start melting. Same effect. So you want to reduce that temperature. You want to reduce that inflation, and one of the best ways to bring inflation down is to increase interest rates, make it harder for people to borrow money, make it more expensive, increase unemployment. That seems kind of weird, isn't it? Increase unemployment. That's backwards. Yeah. Most countries, they want to improve employment, meaning they want more people employed. Yeah. Here we want less people employed. Why? So that they can have less buying power. Right now we're too employed. We have an employment rate of what, 3 point something? That is very low. You put up a help wanted and a help wanted sign, and it's there for a week before anybody even talks to you. So all of these macroeconomics, you have to understand it. You have to take that into consideration when you're trading. How does it affect? So again, long answer on those rates, but you have to have somewhat of a good understanding about macroeconomics when you're trading. So good enough there for you, Regina? Yep. Cool. All right. Let's see. What other questions do we have? Do we have any other questions?
Yes, I have a question.
Sure. What's up?
So I know that Adobe had really good earnings and it really jumped up overnight, but then it kind of went all the way back down yesterday. Do you know why it did that?
I think it's just people taking profits.
Okay. All right.
Yeah. Earnings are a very special breed of event. So they had earnings. Everybody was, kind of knew that they did well, and so that that jump happened. At the same time, some of these prices are they're not the natural prices. So what happens is that as more and more people get into it, that's what pushes that demand up. But when people wake up in the morning, or after they take a nap, whatever, then they realize that this thing is actually kind of too expensive, time to take profit. It's not sustainable. It's going to come down a little bit. So that's just the ebb and flow of things. And that happens a lot with earnings. So, yeah. And it did create a gap too, right? Or did you actually feel the gap, right? Yeah, it filled the gap. So you can see that from this point, it closed at 490 the previous day and went all the way up to 518.74 before it started coming back down. So I don't think it's going to come back down to these areas of 480, 470. next week. I think it's going to continue raising. So that's why I was a little curious why you would prefer a put. Maybe you were looking at the short-term trend, or maybe you're day trading, perhaps.
It was I guess a short-term
Okay.
trade because it was 495, 490.
Okay,
Yeah.
495, 490 spread. So you should have made your money back already if you're not already out.
It was something new for me.
Okay. Do you remember how much you paid for it?
$1 and wait a minute, 1 I think 1.70. Okay.
Okay. I'll check that, see what it's doing. But yeah, I wouldn't hang in there for too long. This is a good trade. I mean, a good
I
stock.
think they said we were going to get out Tuesday.
Okay.
Okay.
Right. Yeah. You should have made your money back actually even by Friday, because it had it took a beating on Friday, which was simply people taking profit. Yeah. Simply that's what was going on. Otherwise, I think with the really good earnings that they presented, plus the product, Adobe is also in the AI space, and anything that has AI in its name or in its strategy is doing very, very well. So cool. All right, guys. Yeah, like I said, this is going to be a short weekend. Tuesday is closed, by the way, guys. Tuesday is closed. So don't wake up early on Tuesday. Right, Mary?
Monday's closed.
Monday.
Monday. Yeah, come back on Tuesday, not Monday.
Right.
Yeah, come back on Tuesday. Monday is closed because of Juneteenth, the holiday. So, all right. Any other hot questions?
Hi, Eddie. I have a question about trading futures.
Mhm.
Do you do that at all?
I trade futures, yes.
Mhm.
Yep. And what's your question about futures?
Oh, well, several people told me that that's the hot thing that they're doing and that I should learn it. And I was just wondering.
Yeah. I think it's hot. There are a lot of hot things, by the way. So
Mhm.
you just have to pick one or two of them and become really good at them,
Okay.
or spend enough time understanding and making sure that you're in a good place. Otherwise, if you take every strategy that is out there, then
It's too spread out.
you get too spread out. Yeah. So
Mhm.
yeah.
Okay.
A rolling stone gathers no moss. Is that what they say?
That's what they say.
That's
Okay.
what
Thank you.
I think I believe them. Yeah.
Okay.
I mean, you open up Thinkorswim or whatever platform that you're trading, there's going to be 1,000 strategies in front of you immediately.
Right.
Do we trade them? No, we
No.
only pick one or two. And that's what you have to do even in your financial planning. Just go ahead and pick one or two things or three things that you can comfortably manage, right? And that will help you out, because each of those things, especially when it comes to trading, require immense concentration. They require planning. They require really good management. So it's really hard to manage 3-4 things at a time, and all of those things have to do with money.
Money. Right.
It's kind of like you're standing at a gas station cashier, right? And he's trying to cash out several people like they do at Quick Trip. Ever been to a Quick Trip?
Mm-hmm.
They're trying to cash out people like 3 or 4 people at a time.
Yes.
I bet their losses are huge based on the mistakes that happen at that point. Yeah. So yeah, you want to, you're serving several customers at the same time, and you are the customer, by the way. So you want to do maybe 2 things or 3 things.
Okay. Thank you.
Mm-hmm. Cool. All right. It's a pretty nice logo over there you got over there, Kanisha. Like it.
Thank you.
Yeah, yeah, yeah. It's an awesome logo. Cool. All right, guys. If there are no other questions, we'll call it a weekend. We do have until 12, unless that's bad. Okay. She must have been commenting about something else. Cool beans. All right. Anybody else got something for the good of the cause? Nope. Okay. We'll drop the mic here. All right. Thank you. Have a good weekend, everyone, and happy Father's Day.
Thank
you.
you.
Yes,
Father's
thank
Day.
you. Happy
Yeah.
Father's Day.
Thank you. All right.
Bye-bye.
Bye-bye.